Now the topic before us is fractional reserve banking in action. How banks multiply deposits. Fractional reserve banking works by allowing banks to hold only a small portion of the customer's deposits as reserves, while the banks can use the remaining amount to make loans or investments. It means that whenever a customer deposits, say rupees 100 in a bank, the banks have to keep a certain percentage as reserves, and the balance amount they can use as for the purpose of giving loans or investments. This fractional reserve system allows banks to create money and facilitate economic activity. We will understand the same with the help of an example. A customer goes to a bank and deposits, say, $1,000 in the bank. The reserve requirement which has been fixed by the central bank is, say, 10%. So the banks will have to keep 10% of this $1,000 as reserves. That is, the banks will be required to keep the reserve of $100. Now, what is the position? This is the deposit of $1,000. Now, the banks have to keep reserve ratio is 10%. Say it is 10%. That is, they will have to keep aside $100 as reserves. Now the banks are in a position to lend out the balance, that is $900 as loan to another customer, say B customer. When the bank issues the loan to this customer B, this is the customer A who deposits $1,000. Now the loan is being given to B customer. Now the full amount has not been given as loan. Some amount has been kept aside, balance has been given on loan. So when this loan has been given, it must be understood that the banks do not usually give it in cash or in hard currency, physical notes or coins. They usually create a deposit. This amount is takes the shape of deposit in the name of B. So a deposit is created in the name of B of the amount of $900. So you will see that these two deposits start existing in the bank. First is $1,000 and another $900. Both these deposits, this one and this one, coexist at the same time. This increases the money supply in the economy. That is, both these customers A and B can utilize these $1,900 if they wish to use the same. So the money supply stands increased in the economy. Now, if the borrower of the loan can now spend that money to purchase goods and pay off debts, the amount spent by the borrower or money received by the recipient gets deposited in another bank. We will understand the same. Suppose now this amount is deposited in the name of B. So it is possible that this customer purchases some building from customer C, from a person named C, and this whole amount is given as purchase money. Now the seller C has received this $900. So this C will deposit it in another bank, say bank X. So when this loan amount of $900 has been given to another person in for purchasing a particular building, now this amount again gets deposited in some another bank X. So now the deposit of another bank increases by $900. Now that bank again will keep 10% as reserves, and they will be in a position to give a loan of $810. So this process goes on. The second bank in turn can lend out a portion of the new deposit, creating even more money. This is often referred to as money multiplier effect. This process of lending and redepositing goes on, leading to expansion of money supply in the economy. So in this way, deposit comes to the bank, banks give on loan, this amount again gets deposited, banks again give loan by keeping some portion as reserves. This process goes on and the money supply increases in the economy. However, a point is to be noted that banks cannot create indefinite money from this initial deposit. It is important to note that actual money creation process can be more complex and depends on various factors. It means that it is not that banks can create indefinite money on their own whims. That is, they can say create $1 lakh from simply initial deposit of $1,000. It is not say. The creation of the money by the banks depends on various factors, including reserve requirements. If the reserve requirement fixed by the central bank increases, the banks cannot lend more. If reserve requirement decreases, banks are in a position to lend more. It also depends on consumer behavior. If the customers do not want to borrow, then to whom the bank will give loan, and the willingness of the banks to lend. If the banks think that the customers may not return the money, then it or the market situation is not proper and it may not get the money in return back. So if the management of the banks thinks that they should not give much loan or should use various techniques to ensure that their initial loan does not get swindled by the unscrupulous persons, so it may decide that they should give loan very after proper verification. They may hold their strings while giving loans. So but the basic concept remains the same. So though the banks give loans and create money supply, or they create money in the economy, but this action of giving loans and increasing money supply is affected by many factors. Sometimes a question may come in the exam whether commercial banks make money or create money out of thin air. This is a very important question, whether banks create money out of thin air. So while this statement of banks making money out of thin air sounds sensational, interesting, captivating, and arousing curiosity, it looks nice. It looks interesting to note that banks create money out of thin air. On an initial deposit, they are increasing money supply. They are creating how much, many times money. They may create indefinite money. However, it is more accurate to say that banks create new money through the process of fractional reserve banking, primarily by lending money. They create money, but they create money by the process of lending. New money is not created out of thin air. Banks cannot create an unlimited amount of money. It means that suppose there is $1,000 as initial deposits, it is not possible that they can create a money of say $100,000. They cannot create so much money. There are restrictions. there is a concept of money multiplier. We will read it after some time. Banks cannot create an unlimited amount of money. They are constrained by reserve requirement and other regulations. There are many regulations which the commercial banks have to follow. So the banks do not create money out of thin air. They cannot create an unlimited amount of money. Thanks for watching. If you like our course, please spare some time to give a star rating to our course.